Okay, welcome to the May 23rd edition of the Fats, Fuels, and Oils webinar. Last week was our conference, and I apologize if I did not cancel the webinar last week. I thought I did, but I got an email from somebody that made me think I didn't. So if you attended and I didn't show up, I really apologize for that. Last week was our conference, and for those of you that I got to see there, it's always great to see people in person. And for those of you that attended and I didn't get to see, sorry that we didn't connect. And I hope that I will see more of you there next year. Couple of little house cleaning things. One, I have a new colleague, Joao, and next week he is going to join us, and you all will get to know Joao much better in the coming months. He's already starting to contribute to the weekly report, and I'm very much looking forward to working with him, and I'm sure you all will all like him. And he's going to help with the next thing that I want to talk about, which is the big gap between the last time I issued a report and this time. We have finally sort of gotten back on schedule, and a big part of what Joao is going to do is help me stay on schedule. So hopefully this will be the last big gap that you see between reports. And with that, let's get going and do our usual thing. This week we're going to talk a bit about the EMTS data that just came out and the beginning of the US growing season. And then we'll go through since the forecasts are actually updated, we'll go through the biofuel margins and the usual stuff that we went through and talk a little bit about RIN prices and potentially sort of what they might do this year. So on Thursday, the EPA released their April EMTS data, and you can see that renewable diesel production, although up sharply year over year, declined from March to April. It was a relatively small decline, especially given the drop that we've seen in margins from the peak in sort of mid-March to last week. They dropped below $2 for the first time in quite a while. We'll get more into margins when we go through them sort of after we do the presentation stuff. But I think that I think this idea about margins and production, it's something that we've talked a lot about in the webinar, and whether renewable diesel producers will continue to produce based on sort of capacity utilization rates, or at least what we kind of assume the capacity utilization rates are and what they should be, or whether total production will kind of then drive margins so low that we need to start rationalizing biodiesel production capacity. On renewable diesel, you can see just sort of based on the growth in capacity, we still have fairly significant increases built in throughout the rest of the year. The next couple of months, I think, will be relatively instructive into solving the riddle of where renewable diesel producers are going to produce relative to the reported capacity from the EIA. They're up above sort of 3 billion gallons now, I think. And so if you look at the EPA data versus the EIA capacity, it implies really low capacity utilization rates. If you look at the EPA or the EIA versus EIA, the utilization rates rise a little bit, but still probably not as high as we would expect them to be. And I still think, and we've talked a lot about that, but I still think that that's going to be one of the key questions going forward for the feedstock markets. Biodiesel production ticked up just a little bit month over month, but still is declining year over year. And biodiesel margins for the week were up, but still are down significantly from their peak in sort of late January. I think, again, thinking about the margins, based on our feedstock mix assumptions, biodiesel you can kind of think of as the soybean oil margin, and renewable diesel you can think of as the fats and grease margins. The decline in margins recently, I think, has had more to do, at least on the biodiesel side, has had more to do with the decline in energy prices and credit values, or I guess RIN values, than it has in soaring feedstock costs like we saw sort of last year. And again, there's this question of exactly how much is biodiesel production going to slow. Our forecast for the rest of 2023 is relatively in line with where we are right now. The one thing that's missing, I think, is, and you can see that we kind of have into the end of the year, instead of sort of the typical, at least historically, surge in production that you would see at the end of the year. This year, we actually have production kind of tailing off into the end of the year. And then next year, we actually have a relatively aggressive cut in biodiesel capacity. And that is based on this theory that renewable diesel capacity growth will drive biodiesel margins substantially lower. All of that said, as I've said here, and I said in my presentation at the conference, I think that it's going to take a lot to get the biodiesel producers to actually rationalize their capacity. If you look at our assumption for biodiesel margins, both in the California market and then in other regions of the US, and you look at what's happened over the last couple of years, there was a sharp decline and then a big bounce back. And currently we are kind of around the upper end of the historical range, or maybe a little bit above the upper end of the historical range. And so you haven't really seen that much rationalization yet. And I think that margins would have a long ways to go before we get to that rationalization. Again, based on the idea that if biodiesel producers sort of survived through the sharp decline in margins in 2020, and given that the outlook is different now than it was then coming back, they weren't facing a lot of competition from renewable diesel capacity. But still, I think that if you're a biodiesel producer, your choices at the end of your choice to close your plant or do something else with it is fairly stark. And so I think, again, I just think it's going to take a lot from a margin perspective to sort of scare the biodiesel producers. Not scare isn't the right word, but force the biodiesel producers to rationalize capacity. All right, and then this is just the combined domestic production. You can see, again, just combined, a small tick down is the decline in renewable diesel production, a little bit more than offset the increase in biodiesel production. And we expect modest growth. I don't think that our expectation for the rest of the year is really crazy in terms of, if you look historically, what production generally does from here through the end of the year. I don't think we have huge increases built into our domestic production forecast. And so while we might vary from one month to the next and might make some modest changes in our monthly forecasts, I think in general, I'm fairly comfortable with our production forecast. The one area that is a little odd is this domestic renewable diesel production, and I apologize, that actually should say EV 1.7. And I've shown this chart before, and I just wanted to show it again to re-highlight this, because I still haven't quite figured out what this is. It's obvious that there is a plant that has opened that wasn't opened and is now producing 30 million or a little bit more than 30 million gallons of fuel a month. There is at least one pathway that I know for sure produces SAF and generates this RIN, the EV 1.7 RIN in the D4 fuel category or under the D4 fuel code. I think that there's another facility that produces renewable diesel that also qualifies for the 1.7 RINs. And I'm not 100% sure which facility it is. The first facility has to import renewable diesel to make SAF. And if you look at the renewable diesel import data, it doesn't really match up with this production. So I'm fairly sure it's the second facility. However, I haven't really been able to 100% confirm that. Still, I think that one of the things about this that is a little odd is the fact that the EPA approved a pathway for under renewable diesel production for SAF production. And I think that's going to make figuring out how much SAF is being produced going forward a little bit more difficult. Now, SAF levels are low enough right now that it doesn't necessarily have a significant impact on feedstocks unless we assume that all of this is SAF production. And if all of this is SAF production, then the feedstock demand looks a little bit different. Of course, we would just shift this from renewable diesel to SAF, but it's just something that I want to highlight. And as I kind of learn more and figure out and come down on one side or the other of this, I'll let you know. If it's SAF production, I think it will be really interesting because one of the things about SAF, at least so far, is that production, at least as reported by the EPA, has been so low that it doesn't really account for a substantial portion of total jet fuel demand. And of course, in the very long term, I think SAF is obviously going to be a key market. And in the really, really long term, it may be the most significant market for renewable diesel as battery technology evolves and more of sort of on-road trucking or long-haul trucking and marine applications are converted to batteries. Now, I don't happen to think that is coming anytime soon, but however far out, I think it is before we can actually do long-haul trucking with electric vehicles. I think it's going to be certainly significantly longer before we have electric jets in mass use. Certainly going to be a long time, I think, before I get on a plane that is powered by a battery. And so I just highlight this just because it's one of those quirky things that's kind of interesting, and it does have some impact on our outlook for feedstock demand, although the impact is relatively marginal because it's essentially just taking the demand out of one category and putting it into another. Okay, so what did the EPA data imply for yields? And I know that these numbers are really wonky and not really that fantastic. I mean, 6.8 pounds per gallon is below our assumption for soybean oil, and so we know that that there's a disconnect. Of course, we're comparing sort of the EPA data again with the EIA data, and there's always going to be a bit of a timing issue there. But I think from a trend standpoint, year to year, month to month, it still is kind of interesting to look at yields. And if you look at our assumption for May versus April, both are slightly below last year, but April rose a little bit relative to May. And It'll be interesting as we get the EIA data to see what that implies for this, and more interesting to see what the EIA data implies for itself. Going forward, I think I'm going to make a little change to our EIA yield calculation. I don't show that today because we didn't get any new EIA data, but I think there's a way to kind of make that a little bit more reflective of actual yields, as opposed to the number that I've shown in the past, which also is below, generally below the numbers that we assume for soybean oil, and certainly below the numbers that we assume for the low CI feedstocks. And then based on production and yields, this is kind of what that implies for feedstock use. Our assumption for April was a little over 2 billion pounds of feedstocks used in domestic production. Again, the bulk of that remains sort of soybean oil, but yellow grease UCO is a significant contributor, as is distillers corn oil. I wrote about choice white grease this week, and the feedstock demand for choice white grease is actually declining. Last year, it declined by 25% year on year, and this year we're projecting a 15% decline. You can see that the band there is relatively narrow, and it's likely to remain narrow and potentially get even more narrow as we go on, especially I think as we start to hit sort of the limit of the fat and grease supply, which we may kind of be close to just based on the price action in the fat and grease markets relative to the soybean oil markets, or the vegetable oil markets, and soybean oil in particular. Again, we'll talk a little bit more about that in a minute when we do margins, but given that movement, it may be that we're already sort of getting close to bumping up against that supply, at least if you consider kind of all of the demand for biofuel and the demand for non-biofuel, which in a lot of cases has not decreased as much as I would have expected this year, especially since, again, we're starting to see the spread between soybean oil and fats and greases narrow. Now, that's also happening in a lot of other areas. Soybean oil blew out, and so those spreads are all starting to come back. We see the same thing in palm oil. And so part of it is just soybean oil coming back to earth. It'll be interesting to see, as those spreads normalize, what happens with the fats and greases relative to vegetable oils, if they continue to follow sort of the traditional move in the trend of soybean oil, but with a lag, or if they start to kind of just go out on their own and are just entirely driven by the supply and demand for each of the commodities. Now, of course, that plays a big role in their prices, but there also is a strong relationship to the vegetable oil markets. All right, switching from sort of domestic production to a wider view, I put this chart up, and it's a little tough, but the inside bar is domestic average daily production. The outside bar is total daily production, or total daily supply, I guess, imports plus domestic production. And then the data labels on the top are actually the average daily imports. And I put this up because if you look back to last fall, you started to see kind of a surge in biodiesel imports into the US that has continued through April. You can see that we still are above sort of 1 million gallons a day in imports for biodiesel. And we're predicting that imports will be roughly 360 million gallons this year. And then next year, you can see we have, like I said before, we have a fairly significant cut in our assumption of biodiesel production domestically. And that also translates into a cut, at least from current levels, for imports. I don't think that the biodiesel production cut will be sort of this sharp. It probably will be a little bit smoother, and we'll smooth that out as we go forward. But I think that the import numbers and the growth in imports is relatively interesting from a couple of perspectives. Given the sharp reduction that we've seen in LCFS credit prices and the decline that we've seen in RIN prices, while the US market still remains a really, really attractive market, it must be that the economic incentive to ship to the US market is lower today than it was a year ago. Now, feedstock costs a year ago probably were higher, and so maybe the production economics weren't the best a year ago, or weren't where they are today a year ago. But even if that's true, then it still seems a little odd to me that imports have taken off the way that they have recently. And again, we expect them to remain relatively strong. And if that is also true, that just contributes to this idea that renewable diesel is going to have to produce at a certain volume to keep their capacity utilization at a rate that makes sense. Biodiesel capacity isn't really going away and is probably stronger than you would expect if you were just dropped into this moment and given sort of the outline of what's going on in the industry. And then if you have biodiesel imports relatively strong on top of both of those things, then at some point you really have to wonder, does the RIN market just crack and really collapse in the same way that we saw the LCFS market do last year? I think we'll talk a little bit more about it when we go through RINs, but I think it will ultimately sort of, I got asked a lot at the conference about RIN pricing, and are RIN prices going to collapse over the course of the year or into early next year, or even just before? Are they going to collapse in order to rationalize biodiesel production? And my answer kind of was a little bit of, well, the supply and demand of RINs is important, but we've always carried really big RIN balances from year to year, and the RINs expire after a year. And so that taints the supply and demand picture a little bit. It's not the same as a storable commodity like soybeans, where I can carry soybeans forward for a couple of years. And so overproduction in one year has an impact on prices because it means something for the future. Because RINs expire, there is a little bit different impact of overproduction in any given year on prices, because you know at least that if they're not used, some portion of the RINs will expire. Now, I don't think that happens a lot, but just in theory, economic 101 kind of theory. And so traditionally, RIN prices have been very well correlated with feedstock costs. And so while it seems really obvious that if we really, really overproduce relative to the mandates, that RIN prices should go lower, because of this expiration feature, it may be that they really are just kind of correlated with feedstock costs. And if that's true, I think we probably will find that out this year. I think we'll probably have a really good idea whether that is true or it isn't. Now, all of that said, in a couple slides, I'm going to show you what we expect our RIN bank balance to do in 2023, and it's a little underwhelming. So this is the same idea for foreign generation of renewable diesel, just a little cleaner and easier to understand chart. And you can see we haven't really seen kind of the same increase in renewable diesel imports that we've seen in biodiesel, at least recently relative to recent history. We are running a little bit above the 5-year average, but we're running below last year, and we're not running significantly different than we saw in 2021. Our forecast for the year is 500 million gallons. And that, given sort of the sharp rise up there at the end of December, that probably is a number that's going to come down in the coming months as we get more data and kind of refine our 2023 forecast. That sharp rise is just kind of a residual number, and so you could probably cut 20 million gallons pretty easily out of U.S. renewable diesel imports right now, and then potentially, depending on how imports do over the coming months, maybe more, or maybe we ultimately will add some back to it. Okay, so getting back to this idea that we are going to overproduce relative to the mandates, the first kind of step to look at that is, what does domestic production look like just relative to the D4 mandate, and what has it looked like sort of historically? And you can see that historically we have always overproduced relative to the D4 mandate. A lot of that has to do with the undifferentiated advanced mandate, which is the advanced mandate minus D3 and D5 production and Brazilian ethanol imports. Whatever that gap is generally made up with D4 production, obviously, and the bulk of that is renewable diesel or biodiesel. So relative to what the EPA announces as the mandate, there's always sort of a built-in volume that we're going to need to overproduce just to meet the advanced mandate. And that's kind of what this chart shows. But what I think is really interesting is that despite what I've talked about for a very long time, you can see that for 2023, at least right now, we expect production relative to the mandate to be a little bit lower than we saw in 2022. And if that is the case, that may be why we're starting to see or have seen kind of this increase in imports. It may be that there actually is some demand there that needs to be filled, and imports are doing that. If this is just domestic production and we're kind of down, the combined domestic production is kind of down a little bit year over year. And then this is the sort of the full picture of the production of biomass-based diesel relative to not only the D4 mandate, but also the ethanol gap. And so you can see kind of what the ethanol gap has been through the years. You can see what we have done relative to the complete mandate, I guess. So the complete mandate would be the announced mandate, the undifferentiated advanced mandate, and the ethanol gap. And so you can see there have been a lot of years that we have actually overproduced relative to that mandate. And that's why the RIN bank has consistently been sort of 2 million to 3 million RINs for a really, really long time. It's only been in the last couple of years that we've actually underproduced relative to that more complete mandate. Now, this year, in theory, we will overproduce, and not in a way that's substantially different than recent history, 2018, 2019. But there still is sort of this question of whether that overproduction, given where the RIN bank is, will force RIN prices substantially lower or not, or will just force biodiesel margins substantially lower. And I think that just kind of going through all of this in preparation for today's webinar and kind of filling in the data from the EPA and kind of looking at it for the first time in a little while, I'm a little less worried about the production, even if we kind of assume that renewable diesel produces a capacity utilization rates that are higher than they have in the last couple of months. That's our assumption going forward. And so in sort of, this is what it gets you. And it's not something that is all of a sudden really far out of relative to history. Now, it may be that in the past, because feedstock demand wasn't such a big portion of the total demand, that the overproduction was less important to the feedstock markets. And this year, especially, like I said, if we're getting close to sort of the using up the available supply of fats and greases, it may be that this overproduction is more important to the feedstock markets than it has been in the past. I think that remains to be seen a little bit, and I think that there are also some competing forces that would suggest that even if that's true, and even if feedstock demand is a little bit stronger than, or even maybe not significantly, but it is stronger than expected, that the sharp increase, or the sharp expected increase in soybean supplies over the next year will weigh on, and has weighed on, soybean prices, and that will drag soybean oil lower. Now, maybe, again, like I've said a lot on this call, maybe not as much as we have seen historically because of the strong domestic demand. But I think that that if you get soybeans to go down substantially, it's really hard to keep soybean oil prices, at least from a futures perspective, at the levels that we've seen in recent years. Now, what we have also seen, at least recently, is that the cash markets are kind of doing the work for the futures market. So the futures market has come down a lot. Basis levels haven't really moved that much, and actually kind of increased a little bit. It looks like they decreased a little bit last week, but basis prices have been sort of rising, and that may be really where this extra demand from the perspective of the mandate, it really kind of shows up. It's not in the futures price, but it's in the basis and cash prices. All right, with that, let's talk a little bit about, lots of questions. Really appreciate that. All right, so let's talk a little bit about margins. Okay. So you can see, generally, we expect that margins will rise through the end of the year, and that's been a little surprising to me, in part because I guess if you think about it, feedstock costs are coming down, but energy prices have been relatively weak, and there's a lot of concern about slowing economic activity, and so I was a little surprised when I put everything together, and it looked like margins were going to go up after a little bit of weakness potentially in the renewable diesel margins, just based on the strength that we're seeing in fats and grease prices. The one thing that I will say is that our energy price assumptions assume that we are at the lower end of a range, and we're going to bounce up. And if we're going to see a significant slowdown in economic activity, energy prices probably aren't going to do that, and that would probably have some impact on our margin forecast. However, I would also suggest that, kind of given the ubiquity of fats and greases and vegetable oils in all kinds of products, that there would probably be an offsetting decline in feedstock costs. But surprisingly, we expect that both biodiesel and renewable diesel margins will remain strong, at least through the end of the year, which again gets back to this idea that getting substantial rationalization in biodiesel capacity, at least by the end of the year, seems unlikely. And we probably will ultimately be raising our expectation for biodiesel production in 2024. And that will have an impact on the 23-24 balance sheets. All right, now on to the RIN forecast. So I think for the first time in a long time, and obviously I haven't done this that much in the past couple of months, but we're predicting RIN prices go substantially lower. I don't think they're supposed to be equal here and here, but nevertheless, we expect that RIN prices are going to move lower. Again, a lot of this has to do with what we expect kind of for feedstock prices. The one thing that I don't wonder is traditionally the spread between the D6 and the D4 RIN has been driven by the ethanol blending wall. And there certainly is, that's still something that is expected to happen in 2023. And so that narrowing still makes sense from that perspective. But the gap between the two has been unusually narrow for an unusually long period of time. And I don't wonder if it's not a little bit that that instead of sort of the D6 rising up to meet the D4, if it isn't a little bit of the D6 rising up to meet the D4 and the D4 rising down or falling to meet the D6. And that's why this spread has been so narrow, and we expect it to remain so narrow sort of going forward. I think more importantly is just the outlook that RIN prices probably are going to go back to levels that we haven't seen in more than a year. And from that perspective, feedstock costs are almost going to have to go down in order to maintain margins at kind of the long-term historical norm. And while that can potentially continue to happen in soybean oil, it does really look like the fat and grease markets, at least in the short term and short to medium term, have bottomed and have rallied pretty substantially from the lows that we saw just a couple of months ago. So again, I wrote about choice white grease this week, and I was really surprised to see that choice white grease was up 7 cents from the lows that we saw earlier this year. And so if RIN prices really are correlated with feedstock costs, you're going to have this tug of war between the fat and grease prices potentially either being stable or kind of rising, and soybean oil prices stable or kind of falling. And then again, the potential for overproduction, although, and I forgot to mention it when I showed the slide, our expectation for the growth in the RIN bank from 2022 to 2023 is only 155,000 RINs. Now, it is notoriously impossible to estimate the historical RIN bank, let alone forecast the RIN bank. So take that number with a huge grain of salt, but it does at least suggest that we're not just going to be piling on, another 3 million RINs or 3 billion RINs on top of the 3 billion-ish that we probably have right now. All right, last thing, and then I'll get to questions, is our outlook for the LCFS credit price. And this is almost the exact opposite of RINs, where each time that I've done this recently, I've had to sort of raise my forecast a little bit, and now it looks like we're probably back on the trend towards higher LCFS credit prices, with nearby prices around 85. And given the anticipation for changes to the LCFS program in 2024, it's hard to imagine that that we'll see a turnaround in this trend, at least in the short term between now and in 2024. Ultimately, if we do produce a lot more renewable diesel and maybe a lot more biodiesel relative to the mandates, that doesn't necessarily have an impact on what's going on with LCFS credit prices, but it does kind of suggest that there's a lot of biofuel out there that's going to need to find a home. That could have an impact on LCFS credit prices going forward. But I think at least right now, the market psychology is that it's bottomed, it's turned, and changes are coming to the program in 2024 that will continue to strengthen prices. And so people are probably trying to get out ahead of that a little bit. All right, let's do questions. I'm so sorry. So I apologize. You couldn't see my slides. There aren't any questions. You couldn't see my slides because I must not have shared the application. So what I will do is I will send the presentation out to everybody. I really apologize. When I do the presentation, I can't see the questions. Like everything else disappears behind the presentation, so I couldn't see the questions. I apologize. It has been a long couple of months. All right, what a bad way to come back. Okay, well, thank you so much for joining our webinar this week. I look forward to next week when I actually will share the presentation and you'll be able to see the slides. In the meantime, like I said, I will send the presentation out to everybody so that they can all see the presentation. Have a great week, everybody, and I will see you back here next Tuesday.